Welcome to our deep dive into the latest edition of the India Inc. Ownership Tracker for Q3 FY25. In this video, we'll explore who really owns India's top companies, how ownership patterns are shifting, and what these changes mean for investors and the broader market. We'll break down the latest data from the National Stock Exchange, analyze trends across promoters, foreign investors, mutual funds, and individuals, and highlight the key takeaways from this quarter's report. Whether you're an investor, analyst, or just curious about the Indian equity landscape, this comprehensive overview will help you understand the forces shaping India's corporate ownership today. Let's start with promoter ownership. In the December 2024 quarter, promoter share in NSE-listed companies declined for the second consecutive quarter, dropping to 50.4%. This marks a nearly 1 percentage point fall over the first 3 quarters of the fiscal year. The decline was broad-based, but most significant among government promoters. Private Indian promoters also saw a slight dip, while foreign promoter share slipped modestly. This downward trend in promoter ownership reflects both market performance and strategic shifts, such as government disinvestment and changing corporate strategies. Understanding these shifts is crucial for grasping the evolving power dynamics within India Inc. Domestic mutual funds, or DMFs, continued their upward march, reaching a record 10% ownership in NSE-listed companies. This surge is fueled by sustained systematic investment plan (SIP) inflows from retail investors, with average monthly SIPs rising 8% quarter-on-quarter. DMFs injected a net Rs 1.86 lakh crore into equities during the quarter, marking the highest inflows ever recorded. Notably, active funds expanded their share, while passive funds held steady. This trend underscores the growing influence of domestic institutions and the increasing preference for mutual funds among Indian households. Individual investors are playing a bigger role than ever before. Their direct ownership in NSE-listed companies climbed to 9.8%, the highest in over 17 years. When including indirect holdings via mutual funds, individuals now control 18.2% of the market, surpassing FPI ownership for the first time since 2006. This shift is driven by strong equity performance, rising household wealth, and a surge in new investor accounts. The democratization of equity ownership is reshaping the market, giving retail investors unprecedented influence. When we look at free float market capitalization, institutional investors dominate, but individual investors' share has been steadily rising. In December 2024, individuals held 19.8% of the free float, while DMFs reached a new high of 20.1%. FPI share, meanwhile, dropped to 35%, its lowest in nearly 2 decades. These shifts indicate a broadening of market participation and a move toward more diversified ownership. Historically, promoter ownership surged between 2001 and 2009, peaking at nearly 58%. Since then, regulatory changes and government disinvestment have led to a gradual decline. The most notable drop has been in government holdings, while private promoter stakes have fluctuated. These long-term trends highlight the impact of policy, market reforms, and strategic corporate decisions on ownership structures. Rise of domestic mutual funds is one of the most significant trends in recent years. Since 2014, DMF ownership has climbed steadily, supported by retail investors' growing trust in SIPs and mutual fund products. Even during market downturns, DMFs have maintained or increased their share, reflecting the resilience and popularity of this investment channel. The shift from direct to indirect equity participation is a sign of a maturing market. FPI ownership has experienced several cycles. After rising steadily from 2002 to 2015, FPI share has faced headwinds from global events like the financial crisis, COVID-19, and geopolitical tensions. Recent years have seen a marked decline, with FPIs now holding their lowest share in over a decade. This volatility underscores the sensitivity of foreign capital to global risk factors and domestic market conditions. Direct individual ownership in Indian equities has hovered between 8% and 10% for over a decade. However, indirect ownership via mutual funds has surged, thanks to the popularity of SIPs and equity-oriented funds. Today, individuals combine direct and indirect share stands at a record 18.2%. This dual approach allows retail investors to diversify risk and benefit from professional fund management. Systematic investment plans, or SIPs, have become the backbone of retail participation in Indian equities. After a brief dip during the pandemic, SIP inflows have rebounded strongly, reaching an average of Rs 25,701 crore per month in Q3 FY25. This steady stream of investments has helped DMFs reach new highs and provided stability to the market, even during periods of volatility. FPIs have shown a clear preference for financials, maintaining an outsized overweight position in this sector. In the December quarter, 31% of FPI investments were in financials, helping cushion the impact of broader market outflows. FPIs have turned more cautious on consumption and commodity sectors while maintaining a negative stance on industrials. These sectoral bets reflect global trends and risk assessments. DMFs have also increased their allocation to financials, reaching a record 27.5% of their portfolio. However, unlike FPIs, DMFs have become more positive on consumer discretionary and healthcare, while trimming their overweight stance on financials and information technology. This diversified approach helps DMFs manage risk and capture opportunities across sectors. As we look ahead, the ownership trends in India Inc. suggest a more democratized and resilient market. The growing role of domestic investors, both institutional and retail, is likely to provide stability and depth. While global factors will continue to influence FPI flows, the underlying strength of the Indian market remains robust. Staying informed and diversified will be key for all market participants in the quarters to come.